My name is Greg Ford, and I'm a senior advisor at Finance Watch, and I should be moderating our two panels today. So, without further ado, I'd like to hand over to our keynote speaker to start us off, Thierry Philipponnat, who is Chief Economist at Finance Watch. Thierry, all yours.
Good afternoon, all. Good afternoon, Greg. Thank you very much for passing the baton to me. Very happy to be with you today. I think we're addressing a very important, essential topic, safe transition for insurers. I'd like to welcome our most distinguished speakers for having accepted to share the thoughts with us. Thinking together is really the objective of today's webinar. The insurance sector plays a very special role both in the mitigation of climate change and in our adaptation to climate change, simply because it plays a very special, indeed an indispensable role in the functioning of human societies. None of us has invented or conceived a society or an economy functioning without insurance. No insurance, no economy. And this is something we have to bear in mind when we're going to be discussing technical matters. Yet, we have to recognize that insuring the world in the coming decades is going to be a growing challenge. Henri de Castres, then CEO of AXA, famously said in 2015 that he did not know how to insure a world at +4 degrees. Thank God we're not at +4 degrees yet, but most authorized voices are telling us that the world is headed for +3 degrees at the end of the century. And climate scientists are telling us that the world at +3 degrees is beyond catastrophic, I'm quoting. The next question obviously is for us today, how do insurers do their job of insuring the world if and when the world reaches a stage that experts qualify as beyond catastrophic? I read last week the recent report by the Financial Stability Institute of the Bank for International Settlements, dubbed Too Hot to Insure, avoiding the insurability tipping point. And I have to say that I found it most interesting. The first thing is I was struck by its title, Too Hot to Insure. Sounds like the title of Finance Watch report. We at Finance Watch had insuring the uninsurable, and most recently we had finance in a hothouse world. So we seem to be on similar lines here. Then I found a number of assertions in the FSI report that I found quite remarkable. Allow me to quote 4 here, as I feel that they could feed today's discussions if our distinguished panelists want to take them on board. The first quote is, and I'm quoting the Financial Stability Institute from the BIS here. An orderly transition to net zero is essential to avoid economic disruptions and financial instability. Let me comment very briefly on this. Certainly at Finance Watch, we've been insisting for several years now that the main threat arising from climate change is the disruption of the world. And when economic disruption comes in, financial instability follows. There is no financial stability in a world with a collapsing economy. So it's really interesting to read the Financial Stability Institute saying fundamentally exactly the same thing. Second quote from the FSI is, I'm quoting now, a major complicating factor is the uncertainty over future climate change impacts, which may unleash extreme events that have not occurred in the past, for example, due to climate tipping points. That's a point we at Finance Watch have made over and over again. And we made it most recently in our Finance in a Hothouse World, in particular emphasizing that when economists assess or try to assess the impact of climate change on the economy, they have to account for climate tipping points and the acceleration phenomena that go with them. The third quote I will make now from the FSI is one saying that the IPCC, Intergovernmental Panel on Climate Change, estimated that between 3.3 and 3.6 billion people are highly vulnerable to climate change. This, again, is for us at Finance Watch something absolutely fundamental. Obviously, when you have roughly 40% of the world population living in what are going to become more or less uninhabitable zones. You can expect massive migrations. And obviously, when migrations of that magnitude happen, it can disrupt the world. And that takes us back to a previous point. And the last quote I will make from the FSI is when it says that this paper, that's the FSI paper, aims to highlight the urgency of addressing climate change impact on insurers' product pricing and underwriting practices. And at the end of the day, this is the heart of many of our discussions today. So the good news is that there seems to be a growing consensus on what the challenges are. This is a good start. The bad news is that the challenges are daunting. But we're not here to be gloom and doom. We're here to find solutions, or at least to reflect on possible solutions. And this is what we're going to do today. And we're going to be reflecting on what insurers' transition planning should look like and how we can tackle the insurance protection gap. With that, I'm now leaving the floor to my colleague, Greg, who will be leading and moderating the debates and our common reflection today. Thank you.
Thank you very much, Thierry, for those opening remarks. That has set the scene beautifully for our first panel, which is on the topic of transition plans. And I'm delighted to present a panel of 4 very experienced speakers. What I propose is I'll introduce each speaker as they start. That way we'll get round everybody reasonably quickly. So our first speaker is Julia Simon, who is Head of Research and Advocacy at Finance Watch. And Julia, could you please tell our audience a little bit about why you think transition plans, mentioned by Thierry as part of the solution, are necessary for risk management, and also how they can best be supervised?
Yes. Good afternoon, everyone, and very happy to be here and using my nice Finance Watch position to kick off the discussion. Indeed, I will talk a bit about transition plans as a solution, and in particular their relevance to manage the risks which are related to transition. So I guess it's not a big secret to anyone that transition plans are quite widespread today. They've started a lot as voluntary commitments, also as commitments of insurers under different net zero alliances, but also they've increasingly came into the regulatory domain, first and foremost as part of disclosure requirements which have been established across different jurisdictions. We see that overall the objectives of transition plans are recognized as alignment of insurance business model and strategies with the objectives of transition, which have been fixed and committed to by different governments. And also making sure that insurers, as Thierry was saying, as very important economic actors in their underwriting and in their investment role, can support the overall economy transition rather than being an impediment to it, which is in itself a very important objective to avoid the massive disruptions of the economy, but also the financial instability which will be associated to it. In this kind of role, the transition plans are also a very important source of information of how the insurance operations, how are their investment portfolios and underwriting portfolios aligned with the economy's transition, which effectively means what are the risks which are associated with transition for the insurance undertakings themselves. And hence, in kind of thinking all of this throughout the last years, and I think a lot of supervisors, but also experts have been on this topic, it leads us to the conclusion that actually transition plans are important tools for the insurance to understand and manage the risks which are associated with transition of the economy, but also with their operations over the time horizons, which are consistent with the time horizons of the economic transition overall and with the climate objectives. And actually, even today, when I was also preparing for this event, I've looked at a few insurers' reports, but actually Solvency and Financial Conditions report. And it's not seldom these days to find also assertions that insurers themselves mention transition targets and portfolio alignment as effective instruments to understand and manage climate-related risks over time. So hence, it leads us to the conclusion that transition plans can effectively be used as a good prudential tool, and this is why they could also be or should be part of the prudential regulation, which also brings us to the important role of supervisors that they are fulfilling in general for different other types of risks that we were more maybe used to dealing with rather than climate-related transition risks. I think a while ago already the community of supervisors under the auspices of NGFS have already also recognized that transition plans are important sources of information on the risks and their management by the insurers to the microprudential supervisors. One more element that I would like to mention here before going into any details is that, of course, at the heart of all of this should be risk mitigation and decarbonization of the world, and not of like financial portfolios, because obviously, as much as we could say we need to manage the exposure of each individual institutions, more in focus and more important is the mitigation of the overall systemic risk, because obviously we only have one planet and one economy, and if we do not effectively mitigate the risks in the system, they will come back to us either on the underwriting or on the transition risk side. And I think this is where the supervisors or the prudential supervisors can also deliver the value added in terms of looking at effective actions and management actions, risk management actions that insurers are doing to mitigate those risks, which could be engaging with their clients, with their investee companies, with their commercial clients on the underwriting side of the portfolio, but also coming up with products and services which are linked to the client's sustainability objectives. So all of these which would really effectively help mitigate the risks in the real world. I'll stop here.
Brilliant. Thank you, Julia. Our second speaker is Matt Scott. Matt is Executive Director at the UK Centre for Greening Finance and Investment. And Matt is based at Oxford University, I believe, and the centre is a government-funded research centre aiming to promote green financing. Matt has also worked with Mark Carney on the launch of the TCFD, and now co-chairs the Disclosure Working Group for the UK's Transition Plan Task Force, which I think makes him very well placed to give us a quick update on the Transition Plan Task Force work in the insurance sector on transition plans. Matt, what's going on in the UK?
Thanks a lot, Greg. And thanks for Julia and Terry's comments as well. I think probably like most people, when I hear some of these stats and figures of the direction we're going in, I think it makes it even more important to have conversations like this, doesn't it, as a community, so we can start to find ways to accelerate the transition. Really happy to just spend a few minutes, Greg, just as you mentioned, talking about some of the work that I've been helping to lead in the UK, which I think has been leading the way around transition plan disclosures. I'll talk to the TPT in a few moments, but just by way of quick background, as you mentioned, Greg, had the pleasure of briefing Mark Carney at the Bank of England about a decade ago, and establishing the Bank of England's Climate Hub. So back then it was a bit of a side of desk activity for me as a central banker. So obviously it's really exciting to see everything that's happened since, including obviously 150 members now of the network for greening the financial system. And in many ways, I think transition planning is the new frontier that we need to embrace and begin to embed into financial supervision, and it's already beginning to happen. But a few words on the TPT. It's the UK's Transition Plan Task Force. It was set up at the Glasgow Climate Summit, so COP26. I'm sure many of us might be heading to COP28 shortly. And the reason it was set up was effectively because many firms were setting net zero targets, and therefore we needed a way to hold firms accountable for disclosing against that target setting. The TPT has a steering group, it has a delivery group, and a number of different working groups within it. You can find out more at transitionplantaskforce.net. But I think what's been really exciting about the work in the UK is the fact that it's been involving many different institutions. So we've got regulators involved, we've got private sector firms, we've got representatives from government, and over 100 different organizations have come together to produce a disclosure framework that was published a few weeks ago. And there's a few real distinctive things that I wanted to talk through. Firstly, there's a sector neutral framework that is quite distinctive, I think, in terms of talking through transition plans as the need for a strategic and rounded approach. And what we mean by that is that when firms are thinking through their transition plans, there's three elements they need to think through. Firstly, they need to be resilient to the financial risks and opportunities that climate presents. The second one is that they need to think about their own decarbonisation, so scopes across Scope 1, Scope 2 and Scope 3. But importantly, and I think in some ways paradigm shifting in terms of the TPT's work, is the idea that we also need to disclose across the economy what different actors are doing to play their role to steward an economy-wide transition. And the reason why this has been really important is this notion of paper decarbonisation, that for big insurance firms and big asset owners and big asset managers, in particular in the financial sector, there's ways that you can potentially green your own balance sheets, either through divestment or just pivoting portfolios to the service sector that might not necessarily be that helpful in greening the whole economy. And as Julia talked about, it's the systemic risks will be determined not by the portfolio emissions, but by global emissions. So I think that's the one thing I really wanted to land in the introduction to the TPT's work, this notion of helping all financial actors and indeed all actors across the economy to become stewards of an economy-wide transition, and one that is not only to net zero, but to a climate resilient economy, taking nature and just transition into account. So for me, it's a capstone really on a decade of work I've been involved with in shaping the climate regulatory and policy landscape. Specific to insurers, I'll finish here, Greg. There is sector-specific guidance that's been published for 40 different sectors that has specific indicators that should be used, from insurers to food and beverage to oil and gas. In addition to that, there's 7 deep dives that have also been published in terms of sector-specific guidance. At the moment, that's just for asset owners, asset managers and banks in the financial sector. But again, there is some high-level guidance for insurers. So let me close there and just say it's been a tremendous amount of work by many institutions in the UK, and something I'm immensely proud to be involved with, and would be wonderful to see it become more wider spread. So a delight to be here, and thanks for the opportunity to join.
Thanks very much, Matt. That's a really good overview and good set of arguments for, as you put it, embracing and embedding transition plans into financial supervision. So our next speaker is Fausto Parente, who is the Executive Director of the European Insurance and Occupational Pensions Authority. Welcome, Fausto. Prior to running the day-to-day management of EIOPA, you were head of supervisory regulation and policy at the Italian insurance supervisor. Of course, this year, one of EIOPA's main activities is, and I'm quoting from the report here, integrating sustainable finance consideration across all areas of work. So it's quite ambitious. Understanding that you can't say too much about the inner workings of what's going on, we'd love to hear your general thoughts about how transition plans could benefit prudential risk management and support the work of the insurance supervisor. Fantastic.
Yeah, thanks a lot, Greg. I hope you can hear me. Yes, true. We have an ambitious agenda on sustainability in general, and this is already since some years. If you go back to our work plan in the past years, you will see that this overarching objective was already there, and we are working hard to integrate, as you said, sustainability consideration in each and every pillar of our system. It's important that insurance play their role. I heard Thierry mentioning how to ensure the uninsurable. Actually, we worked with the ECB recently, and we still continue to work to find solution, basically, to find solution which can put the insurance sector at the center of how to cope with the uninsurable, as it was rightly said. But there are systems. I don't want to spend now too much, but there are systems, and we will continue to provide the policy option to the government to assess the risk and to manage the risk in a better way, having the insurance sector as the key factor to have the first layer of defense against the climate change risk, natural catastrophe linked to climate change risk. Talking about the transition, and you mentioned already that we have been working recently on the dedicated prudential treatment of sustainability risk into the Solvency II framework. Let me say that Solvency II was already evolving towards more and more sustainability consideration. We have been issuing already ORSA, for example, application guidance, how to embed sustainability risk into the own risk and solvency assessment. So it's important that Solvency II continue to evolve to ensure that future challenges stemming from sustainability risk are appropriately addressed. And the transition risk linked to sustainability can be an important driver for prudential consideration, for prudential risk. Think about how the market risk pattern of asset can have, let's say, an impact from sustainability consideration. So it's important that Solvency II as a risk-based framework reflect and address those changes in an effective manner. This is why we have been working on a methodology, on data sources to include this consideration in the framework. And this is the paper we consulted upon last year, which received a number of comments, a number of positive also comment and consideration. And now we are implementing this methodology to come with a proposal, again, a consultation paper, which will address, anticipating a bit what will be the mandate under the Solvency II review. You know that Solvency II review is still in the trialogue, so it's not yet finalized. But we know that on this differentiated treatment of or dedicated treatment of risk differential when it comes to sustainability risk, there are basically large agreement that we need to work on it. We need to reflect it into Solvency II. And so we aim to publish a consultation paper already before the end of the year, if everything goes well, to assess the potential for this dedicated prudential treatment of environmental objective. So wait a bit before the end of the year as a sort of a Christmas gift. EIOPA will publish the consultation paper we are referring to. Of course, no need to repeat our supervisory approach would be always the same. Any implication should be risk and evidence based. We will work, and as always, with a sort of scientific approach. We see at risk, and we provide a possible suggestion in terms of how to adjust the Solvency II framework, the standard formula. Now, on the transition plan that were mentioned by Julia, Matt, Thierry, of course, the transition plan are necessary for the economy, are necessary for all the players, including insurance. It's quite also important that the work already there in terms of CSRD or the proposed corporate sustainability due diligence directive can also influence and make the change in the insurance sector. What we can say is that the action and the strategy described in those pieces of legislation address the reduction of emission, but does not really fit, let's say, the prudential perspective, does not really go into how this can influence, can have an impact on the solvency position of the insurance. So those transition analyses would need to be complemented by other long-term analysis in terms of impact on the insurance business model, risk, solvency position, and so on. So if a transition plan needs to be integrated as a prudential measure also in Solvency II, which is something which is under discussion in the trilogue, some question also needs to be addressed. And this question is how this can impact the investment choices of the insurer. Solvency II, let's remind, does not have a particular, is based on prudent person principle when it comes to investment. So there should be a consideration how this transition plan can impact the choices in investment, how they can impact the underwriting. For example, if a property insurance for an inefficiency house in terms of energy inefficiency can be insured, yes, no, can have this transition plan an impact on the insurability of some risk. So it's not super clear, at least from what we have seen until now, how this insertion of this requirement into Solvency II can be seen in terms of investment choices, underwriting, and more generally that there is a concern, if I may say so, that there can be some overlap, because already now, as I said, the Solvency is risk-based, so it requires already some risk management also in terms of sustainability risk. We issued some paper on to enhance how the sustainability risk can be looked at and checked. So what we think is important is when it comes to integrate a transition plan into the Solvency II framework, it's important that we have some criteria, some room for adapting this into the system and avoid the duplication, basically, because if there is duplication or inconsistency with the other pieces of legislation, this can be detrimental for and create an unnecessary burden for the industry, which at the end are reflected into the cost for people, for policyholders. So important tool for sure can be included in the system with some consideration, some attention, and maybe some level 2 implementing measure that can address this possible risk of overlap or inconsistency. I will stop here for the moment, Greg.
Brilliant. Thank you very much, Fasto. That was extremely useful. And I think people's ears will be pricking up to the sound of consultation as a Christmas present for them. And it's nice to hear you picking up on Matt's point as well about the impact of investment choices and underwriting and how we're looking at the system impacts, not just the impacts on the individual. Let's turn now to Marina Kodrich. So Marina is Head of Own Risk and Solvency Assessment, or ORSA, and Emerging Risk at Generali. So Marina, Generali has a transition plan. Is that right? You've already got one. Great. Okay. So could you maybe say a few words about the experience of writing a transition plan at Generali?
Sure. And many thanks for inviting first, and also for the explanation that we just heard from Mr. Parente, because as you know, we work very much on ORSA related topics. So, but maybe to go back on transition, you know, insurers, in our view, do play a very important role because they are asset owner on the one hand and providers of insurance coverage on the other. Our standpoint in general is that transition is the first lever to fight climate change, because this means contributing basically to mitigation. That is the only way to limit existing and future emissions and avoid global warming above certain threshold that would simply become unsustainable. You just mentioned it before, also in terms of tipping point. In general, lifetime partner driving growth underpinning strategy, as you know, is built on 4 big blocks regarding sustainability. Being a responsible investor, responsible insurer, responsible employer, and citizen. In doing this, the group recognizes the importance of having a just transition, as you also mentioned before, I think, Matt. And this means protecting workers and communities not to be left behind in the journey, you know, to a greener world somehow. For us, this goes along with all the commitments that the group has on decarbonization, the decarbonizing portfolio, which means, of course, exit from coal, which is the first step, but also exclusion of unconventional oil and gas, promoting insurance products with ESG component, green investment and bonds, of course, and not last, let me mention it because it's very, very important, because we are working in an ecosystem, is through engagement with investees and clients. In meanwhile, as insurer, we also understand that adaptation is needed to prepare for a more resilient environment through planning, for example, of green and sustainable infrastructures that could limit at the end the economic and not less important social losses with the intensification and more frequent occurrence of climatic events. As you know, Generali, for example, is dealing now with the intensification of climatic events that in some areas are becoming challenging. And we are working on that by focusing in our underwriting on loss prevention, for example, and loss mitigation, offering clients advices to reduce and mitigate their exposure to climate perils, making at the same time the risk more affordable to insurers. And on this, in general, there are also a number of initiatives. One is on SMEs, for example. Anyhow, both the two planning, the transition and preparing for adaptation require, in our view, coordinated market-wide policy measures, including public and private interventions. Without a proper mitigation and adaptation strategy embraced by all primary industries, we will simply not block the temperature increase and consequently the economic cost, economic and for society. We know it's a double digit what we already have some good quotes around. Insurance industry, of course, can support via investment in risk protection, for example, by thinking on new ways of supporting economies and clients. But as I think Julia also mentioned before, is it a systemic and market-wide issue? So policymakers do need also to intervene through other levers. For example, speeding up other legislative processes, for example, to promote electrification or new electric grid infrastructure, or simply supporting the raising of awareness and subsidizing, for example, part of the cost to avoid at the end the massive impact on final consumer. Last, about transition planning across sector, it is basically important for all economic players. We know current CSRD, for example, Corporate Social Responsibility Directive, already applies to all bigger economic players somehow across activity types. And for this reason, planning transition, disclosing, implementation and reporting will be very, very important. Instead, sectorial specific regulation can also impact selected sector. By the way, not necessarily the most polluting ones. So they could be a little bit less effective because they would not embrace all market players.
Thank you, Marina. That's it's very interesting and nice to hear an insurance company with those 4 different types of responsibility. You don't often hear that from large corporations, usually focusing on a narrower set of stakeholders. And I think the message about needing a coordinated market-wide approach covering all the economic players is very well made and does raise interesting questions for regulation and supervisors. So I think now that we've done the first round, I'd like to go back to Julia again and ask a follow-up question. Julia, as Fausto mentioned, there are already transition plan requirements in other bits of regulation, in CSRD, CSDDD, ESRS, but also, as Fausto confirmed, those don't cover the prudentially required elements. So how would you say we could align the sustainable finance arrangements around transition planning with the prudential needs that you've identified?
Thanks, Greg. And point absolutely taken. I think throughout the work that we've been doing over the last months and maybe even years, we completely agree with the fact that we should not create kind of legislation which duplicates itself or kind of overlaps. because not only it's a burden and cost to the industry, it also defies the purpose, obviously, because if you have a lot of things, eventually the question is like, what do you do with all of that, and where is the borderline? So I guess from that perspective, we think there is a very good way to go about all of this is making sure that all the different, I'm speaking about the EU mostly, legislative pieces which refer or include transition plans should build upon each other, so they should not overlap. There should be a clear cross-referencing to make sure the purpose of each of the regulation is clear. So if we speak about CSRD, is disclosure, CS-DDD or corporate sustainability due diligence is under discussion, but this is the implementation if it comes to that. And then if we go to the prudential side, it also should be very clear what is the prudential purpose of those plans. And I think from our perspective, there is a very clear also prudential use, but which should be centered around answering the questions of how insurers are using their transition plans that they are already disclosing under CSRD to infer the information about transition risks into their portfolio, because eventually the purpose of disclosures is also to get that information, and how they are using it to understand and manage their transition risks over time. And here I come to how we can look at this from the prudential point of view. I think it is important to note, and I guess like everybody of us now, the speakers, we somehow referred to the fact that we need to prevent the temperatures going beyond the point where we will not be able to predict what will happen, or we will have catastrophic cliff effects. So it means that when we speak about also prudential measures, and this is where climate risk is very much different from the risks I think we are kind of used to deal before, or the scale and the frequency of what we see is happening is different. It is important that such prudential measures are designed in a preventive or precautionary, forward-looking and long-time horizon perspective. And this is where actually transition plans are a very kind of handy tool, because they allow to look at the risk across the industry in a consistent manner. We clearly know which time horizons are relevant, right? If we speak about the fact that climate objectives have been agreed based on scientific evidence, so this allows the industry to take a coherent and consistent approach with respect to time horizons, but also forward-looking perspective, long-term perspective, and which at the systemic level would then lead to the fact that these risks can be mitigated. And I think here it would also allow to kind of overcome some of the maybe restrictions, limitations of the current prudential framework, where we still might have a lot of inconsistencies if we do not introduce this common tool or this common understanding of how we look at transition risks.
Brilliant, thanks, Julia. So I'd like to turn over to Matt now with a question to follow up on your earlier explanation of what's happening in the UK. How do you see that playing out internationally in terms of the disclosure of transition plans and transition planning as a process? What is the international story here between what's happening in the UK and what's happening in other jurisdictions, Matt?
Yeah, thanks, Greg, and really interesting to hear Marina and Fasta's comments on this as well. I mean, I think as you mentioned in your question to Julia, there's clearly a little bit of an alphabet soup at the moment, isn't there, in terms of lots of different disclosure recommendations. I think that's one of the reasons why in the TPT's work, we've been really delighted to be working with many different stakeholders around the world, and in particular to flag that the forward of the document, you'll see there's both a forward from Sue Lloyd from the ISSB, which is obviously a key organization in terms of driving coherent disclosure standards globally, as well as Mary Shapiro from GFAN. So I think there's been a real effort to make sure that the framework, and actually the 5 blocks of the framework that the TPT sets out around foundations, implementation strategy, engagement strategy, metrics and targets, and governance, are the same as those that have been put together by GFANs. So I think there's a real coherence coming together around transition planning. There's obviously still more to be done. And again, just reflecting on some of my comments earlier, I think it's interesting to look back, about 10 years ago, is really disclosure around the financial risks and opportunities through TCFD that then became the playbook for a global set of standards, TCFD now being mandatory across many institutions, and the near-term need to manage climate risk embedded into financial supervision. I think now we're at the new frontier is really to move beyond just the short-term management of physical and transition risk, and to help all economic actors to become stewards of the transition. So really placing responsibilities on us all to do what we can to accelerate the transition and contribute towards systemic resilience. And I think that's the frontier that we're on. And I would argue, to some extent, it's already embedded in some prudential supervisors' approach through doing long-term stress testing out to 2050 and putting responsibilities on firms not only to think about today's risks, but to take action today to minimize the future risks that we face and protect long-term value. So it'd be exciting to now see that become more embedded, and this idea of financial stewardship as well as short-term climate risk management becoming core to the responsibilities the financial sector has.
Thanks, Matt. It's great to hear about the focus on long-term stewardship of transition. That's a term that is a little bit different from just managing short-term transition risk at the institution level. And obviously the bit that binds that is the prudential piece. Fausto, you talked a little bit about the gap between prudential requirements, or rather the prudential benefits of transition planning and what's currently in there in the sustainable finance regulation. You also mentioned that it's important to avoid duplication, but also to fill in the gaps. And there was some reference to level 2, a way to bridge that gap. Do you see a prudentially oriented transition plan as a separate document to the transition plans currently being developed, or is this actually just a twist on the implementation of what we've already got?
But I was referring to level 2 measure because sometimes, to be honest, we have too much in level 1, and then we have a sort of constraint in adapting the requirement in level 1 vis-a-vis other pieces of legislation, and especially when the piece of legislation is an horizontal one, to adapt to other framework which are already there, are already implemented. And this is why I mentioned the possibility maybe to have some, if the co-legislator want to introduce transition plan in Solvency II, to not go too much into the detail, because it was not well thought through. There was no call for advice to EIOPA. We did not follow the usual process to arrive at a well-informed decision when we change level 1. That's why I was thinking maybe if they want to introduce the concept, the requirement, high-level principle is sufficient, and then the Julia idea of making some cross-references is quite a good one, and then leave space for implementation in a way which at the moment I don't know what will be, but at least we may have time to consider how to best implement the principle concretely, with proper public consultation, listening to the stakeholder, and so on. So when it comes to your question, if a separate document, yes or no, I can't have an answer now. I tend to think that we should really see what are the role that we can play also in terms of supervising those transition plans, because I see here also a skill gap in terms of how then we can really be sure that are properly implemented if they become a piece of prudential framework. So maybe better to have a bit of time, due process to make a well-informed choice.
Thanks very much, Fausto. It was elegantly answered and not answered at the same time. So just before
we are prudential supervisor.
Yeah, an essential skill. We talked about a skills gap, but obviously there's no gap there. So before we move on to Marina, I just wanted to mention to the audience that you can ask questions using the Q&A tool. please do if you've got some questions, and we'll make sure that they get some airtime. So Marina, I understand that you've done some work on climate risk analysis at Generali. Could you tell us a bit about that and why you think it's beneficial and how that feeds into the transition plan discussion?
Yeah, thanks. I think this is very important because we are integrating climate risk in our overall enterprise risk management framework, and also in parallel to implementing the strategic levers that I mentioned before, that are about the decarbonization, for example. We believe industry here plays again an important role in understanding the evolution of the risk, the transition, and the physical risk. The first, I would say, to contribute at the end to its proper management. To that respect, in Generali, we started a few years ago, and we are keep evolving because it's something that requires to be evolving over time, our own climate risk methodology for physical and transition risk. And it is meant to support at the end underwriting and investment business decision management. We have developed this climate risk, which is now part of our own risk and solvency assessment process. It is since a few years. What we do here is to calculate basically the financial impact on the group portfolios that I mentioned before under a number of scenarios. There is no one perfect future, so we calculate the impacts under 6 NGFS scenarios for what regards to the transition, so moving from the orderly net zero to the disorderly, the NDC, the current policy, and 3 IPCC scenarios for the different levels of global warming at the end for physical risk modeling. We use 3 time frames, and this is of course something new because it integrates also the long-term analysis, short, medium, and long-term time frames. This latter that are the most important to understand the physical risk impact, especially in scenarios, as you can imagine, with temperature increase above 3 degrees, and with presence and with the risk of additional tipping point. We are also currently working to evolve this methodology. As I said, we are working to evolve also to calculate the impact on the life underwriting portfolio, which of course follows the most mature calculation on P&C portfolio and on the investment one. And we are also making progresses on litigation risk modeling, which is per se part of transition or separate if you want. As I said, the purpose of this analysis is really twofold: to support the business decision, through advice for underwriting, investment, start defining adaptations plan when needed. Imagine, for example, for assets located in highly vulnerable zones, for example, but also capture business risk and opportunities, for example, in investing or insuring specific technologies, typical those contributing to transition, electric grids, everything that's around energy renovation, green buildings technologies. These are all very important, both for investment and underwriting point of view. Maybe, and this is something I would like to repeat, these are really based on climate projection, are not prediction for a perfect future, are long-term analysis. They can't capture all possible market trends and behaviors of policy of market participants. And this is true especially on long-term scenarios. For this reason, also what we do today, and we believe it is useful for understanding long-term implication in ORSA, because at the end, this is a Pillar 2 tool. We are less convinced on integrating this together with Brown capital requirement or similar, because as of today, this could have the potential to, at the end, make some market distresses without necessarily leading to a risk reduction. We are more in the favor, of course, of facilitating measure in this case to support the transition, because what we're trying to do is really to push the portfolios, both investees and clients versus greener solution.
Thanks, Marina. That's very useful. And I wonder whether in Matt's eyes that makes you question perhaps whether the TPT was right not to do a deep dive on the insurance sector. There are quite a few tools that emerged in there that generally seem to be employing. So we've got a question here for Julia. Sebastian Mack asks, since there are so many different pieces of EU legislation that already now require companies to establish transition plans, how important is it to include the financial sector in CSDDD?
Great one. It is important. However, I guess in the discussion about CSDDD, we should always kind of look at kind of two strings, which are running sometimes in parallel. There is a question about transition plans, and as well as a question about the general due diligence obligations, which are of course related but not exactly the same. I think the inclusion of the financial sector in general in CSDDD is important because also if we speak about transition plans, this is an obvious one, that the CSDDD builds upon the disclosure requirements in CSRD, whereas it establishes the obligations to implement those transition plans and certain responsibilities of the management and directors for those plans. It is back to what I said before, and I think to what Mr. Parente also hinted to, is it is important to kind of delineate and make sure that the alignment with possible inclusion in the solvency is clear, and that we can kind of balance out the risk perspectives there very well. And I think like the more difficult discussions these days politically is the inclusion of the financial sector in the due diligence obligations, which we very much support, because financial sector, and I think Marina can speak to that much more than me. I used to work in banks myself. Financial sector does due diligence, also with respect to environmental human rights impacts, especially if we speak about CSDDD and the due diligence which is related to fulfilling the obligations of the number of conventions which are in place and which should be taken into account. So I think there is absolutely no question about the fact, yes or no. Of course, there is a question about how far reaching these obligations will be, how you define the value chains, which I think are still very worthy discussions to be had. And very important ones, because of course financial institutions also have certain, they can't kind of look into value chains endless, but there are meaningful things which should be included in there. So I regret a little bit that we are kind of in the situation where we kind of try to scrap everything all together instead of having a meaningful discussion about what is the actual appropriate scope of those obligations. Thanks.
Thanks, Julia. So I'm going to ask a question of my own, if I may abuse my position as chair. It's a very straightforward one, which is that we've heard from all the speakers about the value of transition plans for the industry and the importance of approaching an economic transition, not just to avoid the inbound risk at the institutional level. And then when we've got some industry players such as Generali, which are, arguably taking a lead in this area, if there are others, other companies in the sector that are not following, not keeping up, does that place a detriment to those that are? And if so, there surely is a role for regulation in there. So I guess I'll come to the question, which is, should transition plans be a mandatory requirement in the insurance sector? Does anybody fancy going first on that one?
If you want, Greg, I can try from my perspective. EIOPA is always keen to have supervisory convergence. So if something is useful, it has to be implemented by all the players. So in this sense, I would see this, if introduced in the Solvency II framework, as I said, then it's our role to ensure that all the players play the same game, basically, because I don't like, honestly, to have a single market where players make too much different things when it comes to important risk like sustainability. So if it's introduced, then we need to have a requirement which is implemented by all the players, with some, of course, proportionate approach depending on the size of the different player. But on this, we have the proportionality principle, which is embedded in Solvency II. So we will ensure that the application will be proportionate to the risk scale dimension of the company. But I would say yes, we need to play the same game. It's important for the society.
Fantastic. Thank you very much, Fausto. I think with that, I'll ask people to give their closing haikus or statements so we can bring this to the break. And let's go in the same order that we started. So, Julia, what's your parting shot that you would like people to keep in their heads after this session?
Thanks, Greg. I will maybe finish where we started, and I would say that I'm happy to have had the discussions with the very different stakeholders, and I think we should continue thinking about how we make these things work in the most appropriate and consistent across the industry way. I guess we do have a broad agreement that we need to mitigate the risks because it will impact the insurers, it will impact the society. So I guess it's a good departure point, and if we agree on that and start thinking of how we make it happen and how we can all kind of collaborate and contribute to that, and also us obviously as a civil society stakeholder, I'm happy to have to continue having the discussion. We are also looking forward to the finalization of Solvency II, and we'll definitely be in touch with all the panelists, I hope, in the future. Thanks.
Thank you, Julia. I'm not sure that followed the standard number of syllables for a haiku, but that was a good summary. Thank you. Matt, over to you.
Yeah, I think Fausto said it brilliantly well, really, hasn't he, in terms of the need for a level playing field, and therefore we can reward those firms or at least protect those firms that are showing the leadership that's needed. And for me, that's what it really comes down to, isn't it? I think we're reaching the point where we know we've got a collective action problem and we need collective leadership, and therefore that's leadership from all sectors, everything, everywhere at once, I think, is what we now need to do.
Brilliant. Thank you, Matt. Fausto.
You know, Greg, thinking about how important the insurance sector is when it comes to sustainability, I would rephrase a bit the title of this webinar. Instead of preparing the insurance sector for a warming economy, I would say make use of insurance sector for a more sustainable economy and society.
Interesting. Thank you. Marina, you have the last word.
Well, so on insurance, it was already said, and of course, it is a risk of systemic nature. So it's really important that the society work as a whole across the economic sector, and also, I think, more than ever on this risk, supporting public and private also to work together.
Brilliant. Well, with that, that brings us up to 4 o'clock, and I wanted to say thank you very much to our 4 distinguished panelists for sharing their thoughts and insights. We're going to take a 10-minute break now, and then we'll come back at 10 minutes past the hour to begin our second session on the protection gap.